That's funny. All right. Morning, everyone. Kick it off. Excuse me. Okay. Last night, last couple of days, let's put it that way, a couple of wild sessions on in U.S. markets and global markets in general. There's just so much going on at the moment. There's just really, we've hit a heightened point of volatility that starting to feel a little bit reminiscent of kind of 2008, 2009 again, which is fantastic for the guys that are active in the market. We had a sell-off yesterday, obviously hard in the beginning in the States. We continued to push down kind of midway through the session. Really, the last 2 hours were just a drift higher. You know, we had a couple things out on the day. We had J.P. Morgan, which came out, missed on the day. Wells Fargo was out as well, but they were in line. Obviously, the commodity blitz kind of continued yesterday, with copper really being the leader in the morning. You saw stocks get absolutely decimated in London, especially the diversified miners. We had, and then the drift up at the end of the day, I think just kind of across the board, you saw asset classes start to buoy a little bit. Maybe led by oil a little bit. I mean, oil actually is, I think, right now kind of really looking like a risk-on, risk-off metric at the moment, which maybe is a little bit different from what you normally think. But bouncing it last night into the end of the session, I think drug markets up with it a little bit. So I think really showing you that markets are panicking a little bit about the oil price tanking too low, because they're fearing the unwind of some of the high-yield debt markets that could come crashing down if the oil price continues to come lower. So that's going to be probably a great thing to watch. It's just the oil price as a real barometer for what we need to be doing in the equity markets over the near term. If we look at in the Asian session, we had a nice bounce there as well. We had Nikkei up considerably, and it did it without a real weakening in the yen, a real significant weakening in the yen, I should say. So I think that's a positive. We have Shanghai up nicely as well, Hang Seng up a bit, and Australia still down a little bit. Obviously, a little bit of follow through from those mining stocks, but overall, we're looking at a very clear picture, I think, at the moment. I'll jump into on the charts in just a little bit on one or two of the things that I wanted to look at, but there's a lot going on right now that are throwing out some huge worrying signs at the moment. So they're seeing a lot of the risk metrics really reversed hard in the last few sessions. Obviously, oil tanking down to such lows. Now we've got copper that's absolutely broken down. I mean, copper's lost 20-odd%, I think, only in the last month and maybe even a few days. You've got Japanese yields, which have actually gone yet negative on 5-year, and I think close now on the 10-year. I mean, I was looking last night. I mean, you got Mexican yields all the way down near 3% on the 10-year yields. So what we're seeing right now, we have never seen before. Make no mistake about it. It has never happened in the history ever. I mean, we're looking at 42 basis points on the German 10-year at the moment. There's no yield in the market whatsoever, and we continue to see those things go lower. The U.S. yield curve starting to flatten out quite badly. There's a lot of really worrying signs right now in global markets, and I think we've got to play it accordingly. You got to be very careful out there. I think we've been sitting with a premium in certain markets for a long time as well, so there is a lot of froth that can also come out here. So just be very, very careful, like we say. There's probably no reason to be looking at the long-term picture right now if you are trading in CFD products or actively trading. Keep it short. I don't mean keep it short position, but keep you're trading short term, because things are going to change in a hurry, and we're going to see massive volatility probably for the foreseeable future. So just keep that in mind. All right, we're looking out to the charts of interest today. We've got chart here from Jeff Gunlock and Zero Hedge. oil and gas employment could start plummeting. One of the things that I think is so worrying at the moment is that, what from some of the things that I've read is, people are pegging it as much as, 60, 70% of the growth in the States since the Great Recession has been out of the oil and natural gas sector, and you can really see it there. Overall employment since then has just been hugely driven through that. So, by that chart, it probably looks a little bit higher. But bottom line is, you're going to see some of that employment definitely start to turn around as the oil price stays low. And I think the market's starting to discount that. I think the market's starting to discount what that's going to do to the American economy, even though you've got significantly lower gas prices, which is going to be a boost to the economy. That's also going to cause a lot of turmoil in terms of the jobs market and that sort of thing. So, not all positive effects by the lower oil price. Right. This morning we had Richemont out with its third quarter sales release. Overall, looking a little bit soft. You can see it's a bit of a mixed bag there between Europe and Japan, with better numbers. Asia, to be honest, it looks like a total shocker, and America is also looking like a total shocker. But I think the Asia number is probably the real worry. Obviously, you can see the total sales number versus the estimate looking a little bit soft. But it doesn't look like a huge miss. So we'll have to see how the market's going to react to it today. We've got also same thing out today in Mr. Price and in Woolworths. We're looking for Bank of America later in the States today, as well as Citigroup and Schlumberger. So we had Goldfields, which is cut to sell versus buy at UBS today as well. So just keep that in mind. All right, in terms of market data out today, we've got had Japanese PPI numbers, again, a little bit soft. Japanese machine orders, a little bit soft, or a lot soft. We've got U.S. Empire Manufacturing, PPI final demand, initial jobless claims, Bloomberg Consumer Comfort, and the Philadelphia Fed business outlook. So as I get just into the maps here, we're going to keep it short and sweet on the maps because things have just been ripping so hard around. All there's a lot of charts you can show that have had total breakdowns, but they're quite obvious. One of the things I wanted to talk about is simply the environment that we've gone into. You can see in bond yields, you can see in commodity prices. You're going to start to see it probably in the CPI baskets globally. I would assume very soon. Is that we're definitely entering into a deflationary environment. Japan's got deflation. They got the most aggressive monetary policy in the history of the world right now. The U.S. Doesn't have deflation, but it's also had the most aggressive monetary policy that it's ever had, which is now calling out of the market. You've got European deflation. You've got even South African CPI basket, which was running up at very hot, up close to 6% now. Expectations for it to come down to sub 3%, and that's an incredibly quick turnaround. So you're essentially hitting a global deflationary environment. So, sorry, I left China out. China's CPI basket hit negative numbers in their most recent reporting period. So when you throw that into the mix, deflationary environments are terrible for are terrible for global equities. I know it seems it doesn't necessarily make sense when you think about it to an extent, but deflationary environments are terribly bearish for equity markets. So just think about that. We're entering into a global deflationary environment at the moment. These guys can print as much cash as they want. What you're seeing in commodity prices right now is absolute proof that it is not working. I think that this is an environment we've got to be very careful. We can see some things that never happened before potentially to happen in equity markets over the near term. All right, let's look at the Aussie this morning. Nice bump up here. Obviously, you can see off of the close. I think today, going into the U.S. session, markets are going to be very nervous. I think we probably will test the downside at some point. Just keep that in mind. It's going to be very hard for us to just freaking take off all of a sudden after all of these things have crept in. There's a level down here, maybe around 41,830, which we got close to yesterday. If we come up on that again, that's a big, big level, as you can see here. We bottomed out twice there. on these big corrections. If we drop that level, we've got a huge downside from there. I know that we're 750 or 800 points, sorry, above that level at the moment. But obviously you've seen the scale of the moves over the last few days. 800 points is just a couple hours around here these days. So keep that in mind. We could see some real volatility if we do start to get down there and close to those levels and we drop it. Then watch out below. Things can get ugly fast. I'm going to look at a global bellwether here at Grindrod, and unfortunately, my apologies that I haven't been pointing this one out. I hadn't been paying a whole lot of attention to it and just noticed it now, that this thing has just been peeling off since July. It highs up around 29 bucks. We're trading all the way down. We traded sub 20 yesterday at a point. I mean, that is just a vicious collapse when you think kind of the global economy is really doing well. And this is kind of a canary in the coal mine here. So we traded, when we traded below 20 and a half, we really broke down here. The target for this breakdown is as low as 1650. So, watch closely here. Sorry, it would be 17 bucks. Watch closely here. I think if we, can hang below here, I'd like to see it maybe some confirmation with a push below 20. We could really have a nice move down here to the downside in Grindrod, but this is more than anything just worrying for the big picture. So keep an eye on this one. It could continue to be a bit of a leader. All right, Tiger Brands yesterday. Tiger Brands had a nice reversal off of major support yesterday. You can see here, I'll actually draw this from that little close right there and then from that wick. So right there at about 345, huge bounce off of support yesterday, about 15 bucks. And I think it's just further cementing the significance of this level down here around 345. I have a look at another look at Coronation here. I'm going to stretch this out a little bit. So we've got a little bit of an ugly head and shoulder kind of setting up here. And when I say ugly, I mean properly ugly. And the reason why I feel like I can kind of draw it that way is simply because the close here is up around there. So dropping what is definitely some sort of support. I think that we've got a significant way to fall here. This thing has outpaced a lot of the others. These are very cyclical stocks. I'm talking my book here a little bit because I'm short of this one, but I think that we're probably going to come in to test this 100 level and maybe the 200-day moving average very quickly now if we continue to get some heaviness in our equity market. I think this is going to be real interesting if we do get into a bit of a bear market. I know that they made 42%, if I'm not mistaken, of their earnings out of performance fees in 2013. That's obviously not going to happen probably from 2014. So I think earnings potentially could really be under pressure. It'll be interesting to see how this plays out. And that's really it for today, guys. I don't have a whole lot that I'm going to show you. Things have just been so volatile. I want to wait till we settle in and start to see something really defining happen over the next few sessions for us to make some bigger, longer term calls. And that's it for today, guys. Thanks a lot.